Chapter 9 discusses long-term assets. Sometimes these assets are referred to as non-current assets or fixed assets, but either way, long-term assets are assets that exist for long periods of time, hence their name, long-term assets. These assets, like any other asset, show up on the balance sheet, but they're not listed under current assets. Instead, they have their own category of non-current assets. So after we've got current assets here, non-current assets would then start to show. And one of the first non-current assets that you'll see is property, plant, and equipment. Non-current assets, because they last for a long period of time, have specific rules in how we account for them. We have to show their use over a period of time. And actually, you've been exposed to the life cycle of a non-current asset or a long-term asset in prior chapters. There are typically 3 journal entries that take place with non-current assets. Those journal entries are when we establish the asset. And again, this is a journal entry that you're familiar with. For instance, if we buy a building, we learned in Chapter 2 that our journal entry is debit building and credit, however we pay for it, for instance, cash. The standard, straightforward journal entry. But because that building, because that non-current asset, because that property, plant, and equipment will stay on the balance sheet indefinitely now until we show its use, we have another journal entry that takes place, which is referred to as depreciation. And this was a journal entry that you were exposed to in Chapter 4. This journal entry debits depreciation expense and credits accumulated depreciation. And if you don't remember that that accumulated depreciation account is a contra asset account. This journal entry is used to take a portion of that non-current asset from the balance sheet and move it to the income statement. So this depreciation expense is an income statement account, and it will show the use or the cost of the asset over its life. Remember that this non-current asset right here, this building, again, it stays on the balance sheet indefinitely. We show its use through this second journal entry of depreciation. And then finally, at some point, this is journal entry that you have not yet been exposed to, at some point we dispose of the asset. And when we dispose of the asset, we get rid of it. And I'll go through that journal entry in a subsequent video in more specificity, but the basic idea is that we remove the asset and its related account. So we would debit accumulated depreciation because it's related to the asset that we're going to get rid of. We would credit the asset itself, the building here. And then we could have some cash that's involved, so we might debit cash here if we receive something for selling it, disposing it. Or we could receive no cash. And additionally, we could have what's new for us in this chapter, a gain on disposal or a loss on disposal. We don't have to have these accounts, but we could. And again, I'll explain them in subsequent videos. And keep in mind that these ones in black, they are an either or none. You wouldn't necessarily have them, but if you did have them, you wouldn't have both of them. You would have one or the other. With all this in mind, there's a couple things that I want to point out in this introduction video that we will build upon in subsequent videos. You might hear me refer to those subsequent videos as this being a previous class. What I mean is a previous lesson, the previous video that we had. But first, I want to talk real quickly about this established journal entry. I want to remind you, and we've talked about this in the past, this was in Chapter 2 actually, but when we establish a long-term asset, a non-current asset, I want you to remember that our establishment of that asset requires us to debit the asset for everything necessary to get the asset ready for its intended use. And this is what we refer to as in long-term or non-current assets as the capitalization rule. I'll talk about it in subsequent videos, but the capitalization rule says that we will capitalize or record as an asset, and that's what we're doing when we're increasing this building account. We are recording an asset. We will capitalize or record everything necessary to get the asset ready for its intended use. So, in consideration of some non-current assets here that exist in the areas of property, plant, equipment, we have land, buildings, and equipment. And these are some of the costs that would be necessary to get the asset ready for its intended use. So for instance, for land, we could obviously capitalize the purchase cost, the price we pay for the land, but we could also capitalize legal fees, survey fees, title search fees. For building, obviously we can capitalize the purchase cost, but we could also capitalize legal fees, appraisal fees, architect fees, etc., etc. So remember that the capitalization rule, the amount that we record, that's what we're referring to, the amount we record as the building account is everything necessary to get the asset ready for its intended use. And again, building is just an example. That could be true with land, that could be true with equipment, or any of the other assets that you see as long-term or non-current assets. The second item that I want to draw detail to is this second journal entry of depreciation. When we refer to depreciation, we're referring to use. And this amount that we record right here is really just an estimate of what that use is. And there's a number of different ways that we could come up with those estimates. We actually discussed these back in chapter 4, but we didn't go into the detail. Again, a subsequent video will discuss the detail, but I want to remind you that there are three primary ways that we record use as an estimate. One of those ways is what we refer to as a straight line method of depreciation, which records the same amount of use each period regardless of the actual use. Again, this is just an estimate. There's also the units of production method, which varies the amount of use being recorded each period based on actual use that we estimate based on the units produced. So for instance, a piece of equipment might make a certain number of units of inventory. So based on how many units it makes, that will be how much we show in use of the equipment. Or we can change this definition slightly to say something like miles driven would be quote unquote units produced. And so a miles driven on a delivery van or something like that might show the use of that piece of equipment based on its output, its miles driven. Another common method is what we refer to as declining balance. And declining balance indicates that the asset is more efficient in its earlier years and less so as it progresses in time. So this is the one where we have a declining slope, where we show more use in the beginning. We get more out of the asset here than we do down here. Again, I will talk about the specifics in these calculations as we progress in the videos, but I want to remind you that these methods are how we're going to discuss estimates for coming up with the depreciation, the use of the asset over time. And there are other methods. These are not the only three. These are just the three that we introduce in this introductory course. The other item that I want to draw your attention to, again, with that same journal entry, that second journal entry, are the three components that you're going to need to understand for the calculations of these three methods. So in subsequent videos, we will start to look at the actual calculations of each of these three methods, and they require you to be familiar with the definition of three components that will serve as inputs to these calculations. The first one is asset cost. And again, when we refer to asset cost, we're referring to the capitalized cost, that capitalization rule, which is essentially the amount that we debited right over here for whatever the asset is, building, equipment, whatever. The second item that I want you to be familiar with is what we refer to as useful life. Useful life is an estimate of the asset's useful economic life to the company, which is not necessarily the economic life of the asset itself. For instance, the asset may be good for the company to use for the next 5 years, and then it might sell it or intend on selling it because it no longer has economic usefulness for that company, but it could have usefulness to someone else. So the economic life and the economic useful life for the company are two different things. But when we refer to useful life, that'll be how long the asset will last to the company. Now remember, how we measure that depends on the method. For instance, straight line is going to measure this in years. Double declining balance is going to measure it in years as well, but units of production will measure it in units. So you don't necessarily have to measure it in time. It's the useful life regardless of how we measure it. And the final thing that I want you to be familiar with in terms of a definition is residual value. Residual value, which is sometimes referred to as salvage value, is an estimate of the amount the company will receive when it disposes of the asset. So in other words, how much money the company will get once the asset no longer has an economic usefulness to it. That is the residual or the leftover value that we will not use up because it's going to be sold to someone else. So to give you an indication of how these units or how these components are all going to work together, the straight line calculation, essentially you'll see this in subsequent videos, is cost minus residual value divided by the useful life. And this is going to show us our calculation for straight line. Now, I don't show you this to say, memorize this calculation right here. I show you this to say these are how these inputs right here go into a calculation that you will see in subsequent videos. And this calculation will then give us our amount that we're going to record as depreciation. So that's how those are working together. The last item that I want to highlight in this introductory video for non-current or long-term assets is how we typically split those out into two different categories. Long-term assets, oops, supposed to be an S here. Long-term assets are typically split into tangible and intangible assets. Tangible assets have a physical existence, or at least they get their value. They get their value out of their physical existence. Intangible assets have no physical existence or substance. I guess you could say that they have limited existence, but it's not where their value is derived from. And I think this is made clear when you look at illustrations. So for instance, a tangible asset illustration is like we have above, a building here. This is my awesome picture of a building. So this is its physical existence. Or you might have, a delivery van. This has a physical existence. Whereas an example of an intangible asset would be a patent. So a patent has a physical existence, I guess you could say, in its paper form, but where it derives its value is the rights that it confers to the holder. So a patent would prevent anyone else from copying a methodology or a product for a certain number of years. Typically, the legal existence is going to be 20 years. So the rights that it confers is really where the value exists. Whereas over here with a building, the benefits are really its physical existence. The fact that it exists and we can house employees there or hold inventory there or provide, sales floor there. That's really what the value is for this asset. So its physical existence is where the value is derived. Whereas with a patent or any other intangible asset, the rights that it confers is really where the value is derived from. In subsequent videos and class periods, we're going to focus right now on tangible assets. And then as we finish up our discussion with tangible assets, we'll move on to intangible assets. But I want to make sure that you understand the distinction between the two.